Most Forex traders lose money not because of the market itself, but because they completely underestimate the importance of managing risk. It's not just about picking the right currency pair or timing your entry. If you don't have a solid risk management plan, you're setting yourself up for failure from the start. You could have the most advanced trading strategy in the world, with all the technical indicators and backtesting you want, but if you ignore risk management, you're basically playing Russian roulette with your trading account. One bad trade could wipe you out. So how do you avoid joining the 90% of traders who end up blowing their accounts and walking away from Forex for good? The answer is simple. Learn to manage your risk like a pro. Forget the Instagram gurus and their flashy cars, rented mansions, and promises of overnight riches. Most of that is just hype and marketing. Real trading success is much less glamorous but far more rewarding. The real secret to long-term success in Forex? It's not about doubling your money overnight, it's about preserving your capital, protecting your downside, and growing your account steadily and consistently over time. Let's break down 10 essential Forex risk management tips you absolutely can't afford to ignore if you want to survive and thrive in the markets. Most beginners make the mistake of using the same fixed lot size for every single trade, almost like trading on autopilot. But markets are always changing, and this robotic approach can quickly lead to big losses, especially when volatility spikes or your account balance drops. Instead, you should use a percentage-based risk management strategy that adapts to your account size and the unique risk of each trade. Decide in advance what percent of your account you're comfortable risking per trade. This is the foundation of smart trading. Most professional traders never risk more than 1% of their account on a single trade, no matter how confident they feel. For example, if you have a $1,000 account, risking 1% means you're only willing to lose $10 on any given trade, keeping your risk small and manageable. Calculate your lot size based on your stop-loss distance and the currency pair you're trading so your risk stays consistent no matter the trade setup. This approach keeps your losses consistent, protects your account from big drawdowns, and helps you trade with confidence and discipline. Setting stop losses too tight on volatile pairs is a classic mistake. The market can hit your stop, then reverse in your favor. Use the average true range (ATR) indicator to set your stop loss outside normal price swings. This helps your trades survive random market noise. Give your trades room to breathe and reach your targets. Making money on a demo account is easy. There's no real risk involved, and it's simple to feel confident when nothing is truly at stake. Demo trading is a great way to learn the basics and practice strategies, but it doesn't prepare you for the real emotional challenges of live trading. But live trading is a completely different game. Emotions like fear and greed kick in and can easily sabotage your plan, even if you were disciplined on demo. That's why it's smart to start small when you go live. Use low leverage or open a micro account to limit your risk and get used to the pressure. The goal is to gradually get comfortable trading with real money, so you can learn how your emotions affect your decisions in real time. Build your confidence and discipline step by step before thinking about scaling up your trades or increasing your risk. Remember, don't let demo wins give you a false sense of security. Real trading is where the real learning begins. Hedging sounds smart, but without a plan, it's a disaster waiting to happen. You might get lucky, but eventually, it'll catch up to you. Only hedge with structured strategies or in specific situations like major news events. Do your research before you try to juggle trades in both directions. Averaging down, adding to a losing trade, will blow up your account fast. Instead, focus on adding to your winning positions, known as pyramiding. Maximize profits while keeping risk under control. Blindly following signal groups is dangerous. Always have your own risk management plan before using signals. Only use signals with clear entry, exit, and stop-loss levels, and understand the risks. High leverage promises big returns, but it can wipe out your account in seconds. Using 500 leverage is like driving a race car without a seatbelt. Start with lower leverage, like 50 or less, to protect your capital. Give yourself room to learn and survive. Trading without a plan is like building a house with no blueprint. Your plan should cover entries, exits, stop loss, position size, and risk management. A solid plan keeps you disciplined and focused. Trading multiple correlated pairs isn't diversification, it's doubling your risk. For example, EUR-USD and USD-CHF often move in opposite directions. Check a currency correlation table before opening trades on multiple pairs. Avoid unnecessary risk by understanding pair relationships. You don't need to trade every day to succeed. Overtrading kills accounts. Focus on quality, not quantity. Wait for high probability setups that fit your plan. Sometimes the best trade is no trade at all. Those are 10 risk management tips you won't hear in get-rich-quick courses. They're not flashy, but they're the foundation of long-term trading success. If you're losing money, it's probably your risk management, not your strategy. Like and subscribe for more cold truths to make you a better trader.